see, now that I know a bit about you all, I'll quickly introduce myself. First, I'll welcome to this session by Navigro. This is the second series of the live sessions that we did, and the response for the first sessions, the first 8 sessions was great. So I thought, why not provide all of you who are ready to level up with a process to use progressive exposure money management techniques and trade management techniques. See, this is something that only the private community of Navigro usually had. So all the members have seen this, whoever were a part of the community. But this is the first time that I am sharing this process for, first it is for free and open domain. So yeah, I hope you make most of this. And we'll talk about progressive exposure, money management, and trade management. That is the agenda for this session, and I'll be taking the session. For those of you who don't know me, I am Kavish Javeri. I have been trading since 2019. I am a full-time trader and I'm trading for a living. And Navigro is my startup. I'm the founder of Navigro. It is a financial services company wherein we manage money for people. I have tied up with 30 plus fund managers across India, and together we help investors build wealth. Also, traders who look to manage their money on their own. I also mentor a lot of people. Last year, I mentored a lot of people who have made stellar returns even in a choppy market. So yeah, that is something that we do at Navigro, and everything that we do is based on data and the deep dives that I have done and we have done as a community. And yeah, this progressive exposure framework that everything is influenced by Mark Minervini, but I took that template and made something for myself. So the terms might be similar, but everything that we do is quite unique. Some people might be doing it. I'm assuming they might be doing it because there's nothing new in the markets. But yeah, this is just my approach, and I would request each and every one of you to have an open mind and not have the prejudice that they probably have about progressive exposure, because this term is taken in a very bad light on Twitter and on social media, because the popular opinion is that progressive exposure doesn't work. But trust me, I have been managing money for people, and this has helped me a lot. And even the community members can vouch for this, that progressive exposure is something that has taken them to another orbit. So I'll not overhype it. We'll just move on with the session, and you decide if this is something that will help you. And personally, I find it a very beautiful concept. And without wasting any of more time, we'll just go ahead and start this session. First, you know, uh, most of us don't know what progressive exposure is. See, we'll not overcomplicate it. इसको हम बिल्कुल भी complicate नहीं करेंगे. And when I say what is progressive exposure, remove everything, every knowledge, and every bit of information that you have about it. Just remove it and put it aside for the next 2 hours. We'll start off on a lighter note. Progressive exposure. What you see on the screen is just a representation of progressive exposure in daily life. See, if you have ever gone to a gym and you're starting out, you don't lift 50 kg dumbbell on the first day, assuming you're an average person like me, who will find it difficult to lift a 50 kg dumbbell on the first day. So you start off small. You start off with 5 kg dumbbell, maybe 7.5 kg, 10 kg, 15 kg, but you don't lift the heaviest dumbbell in the gym on the first day. This is exactly what progressive exposure is. So if I have to explain progressive exposure to a 5-year-old or my sister who's not into the markets, I'll just show them that this is progressive exposure. You don't lift the heaviest weight on the first day. This is a layman's way of explaining what progressive exposure is. Now, getting a little deeper into the concept, see, इसमें आप लोग सुन के डरना मत. Don't confuse yourself or think this is a complicated process. It is very simple. It is simply letting your winners finance bigger risk. What does this mean? By the end of this session, you'll have a clear idea as to what is letting your winners finance bigger risk. Just remember this quote. Okay. So most people feel that progressive exposure is a strategy, that I'll put in 0.5% risk first, then I'll scale up to 0.75, then I'll scale to 1% risk on capital. And this is progressive exposure. How many of you feel that this is progressive exposure? Just give me a yes, or You can unmute yourself and say if you agree. How many of you feel that progressive exposure is risking, let's say 0.25 first, then 0.5, then 0.75, and then 1%?
Yeah. What I have observed that this is only progressive exposure. First build position with 0.25. If your situation, if your trade goes well, you can add more. If your trade goes again, you can pyramid more. This is the concept of progressive exposure that I know.
Okay, perfect, Ravi. See, this is a concept popularized by Mark Minervini, wherein he says start off small, build a profit cushion, then risk more, again build a profit cushion, then again risk more. And अब इससे होता क्या है? See, this was not supposed to be a exact, a strategy to be used. That I'll start off with, let's say, $250 risk. What you see here. I'll make let's say $500, that is 1:2, and my profit is $500. Then I'll risk that $500, make $1,000 profit, and my profit will be $1,500, adding 500 and 1,000. So everyone feels that this is progressive exposure, but this was just Mark Minervini's way of explaining the concept. This was not supposed to be used as it is. So for now, just assume that this is not how we do things. This is just an example of how we can do it. So progressive exposure kya hai? It is just a framework. It is not a strategy to gradually increase exposure as the trade succeeds. So agar aapne, I'm just giving you an example. This is not how you do it. This is now not how I do it. So if I take a 5% position and it performs well, I add more exposure, let's say of 10%. Then again, I add 10%. So you don't do the exact same thing. I'm just trying to tell you that you build on success. If the trade works, only then you increase exposure. And if it fails, you are already starting off small, so you're not risking more. Like you're starting off with $250, you make $500, then you increase risk to $500. Okay, you don't risk $1,000 on the first trade itself. So this was the concept that Mark Minervini popularized. But what most people feel is that this is how you do it. You start off with a quarter position, then you build half, then you build full, and then you build multiple positions using this profit cushion. How many of you feel that this is how you do it? Like Rajesh said, like Ravi said, you start off small and then progressively you build up. This is what most people, make a mistake wherein they blindly copy this framework. But for now, we'll not, assume that this does not work. We'll just assume that right now we don't know anything about progressive exposure. It is just a way to gradually increase exposure or decrease it when the trade fails. Is that clear?
Yes.
Yes. So
Yes.
for now, see, this is nothing new. Again, I'm just talking about what Mark Minervini has, enlightened us with. But I'm just giving you one foundation that what you see on the screen, this is not how you do it. This is a short way of not profiting from the bull swing. This is something that was meant to be just a framework, not a strategy. Fair enough. We'll move on and I'll show you how this is not how you use progressive exposure. It was just a framework. Like why we use progressive exposure. So according to Mark Minervini, he's trying to tell us that if you're not profitable when you are invested 25%, you have no right to scale up to 50% or 75% or 100%. If you are not profiting from a smaller investment, आप क्यों ही अपना allocation बढ़ाओगे? So this was the concept, but most people think that this was the strategy and they leave the concept aside. The concept was simple. You only scale up if you have traction, if you have a profit cushion, or you have a positive feedback. And see, this is directly coming from Mark Minervini's book. Everything that I do is built upon his work. So you will see a lot of examples from his books, a lot of examples and a lot of terms that he uses. So, okay, so bear with me. Progressive exposure, I use it to limit risk. Why do we want to limit risk? See, I think George Soros said this. When you're starting out, जब आप start कर रहे हैं and आपका पूरा capital at risk पे है, जैसे आपने 10 लाख से start किया, you don't have a profit cushion, so everything is risk at that point. It puts a lot of pressure on you if you don't have a profit cushion. But when you have a profit cushion, you can compound that money in a very fast way. Because when you're starting off, you are in the fear that you might risk your capital and you might do losses. How many of you feel that? That when you're starting out, and if you risk more, you have that fear, and you are uncomfortable with that trade whenever you are coming from 100% cash.
Yes, very true. Actually, if I am in the same position, I used to be over cautious and I used to change my plan, like revising my stop loss on all these things.
Yeah, so that makes you jumpy.
Yes.
So that is the first, the first importance of progressive exposure. So if you're starting off small, and again, I'll remind you, we are not talking about start with $250, make 500, then 500, then 1,000. No, we are just saying you're starting small. By starting small, I mean risking a small part of your capital. So when you're starting small, even if if you take a loss, it does not affect your psychology. So that is the first element wherein progressive exposure helps us. Also, it also helps us reduce our losses in a unfavorable market. Not only losses, it helps you maximize your gains. So see, when you start out, you start off small. You only build positions on the way up if you have positive feedback. तो अगर आपके पास positive feedback होगा तो gains तो automatically आएंगे ही ना. You are only exposing when the trades perform well. So that is the second and a very important part of progressive exposure and how it helps us. Third, it prevents overexposure. What I mean by overexposure is, let's say you're just starting out from cash, आप 100% cash में थे and आप धीरे धीरे deploy कर रहे हो, conditions unfavorable है. अब आपको पता ही नहीं है कि slowly start करना होता है ना, आप first day पे 100% invested हो जाते हो. That is a short strategy to lose money. And I am assuming that many of you would have done this wherein you overexpose yourself in a very short amount of time. Has that happened to anyone or with anyone?
Yes. In my initial in 2024, I repeated the same mistake and lost a lot of my gains because of reckless behavior in bull market. We tend to repeat that in bear market also and choppy market also, but things doesn't go well in uh, choppy market or bear market. So we learn about it. Yes, I have committed that mistake.
Correct. And not only you, Ravi, many of the new traders who are starting out, they have this fear of missing out. Like they want to be in the market all the time. And if I, share this stat, you don't have to be invested all the time to make a triple digit return. Go and do the math. Even if you are 30-40% invested around the year, around the full year, even then you can make a triple digit return. That is something that is achievable, not very difficult to do. No, if not a triple digit return, you can even outperform the benchmarks without even investing 100% of your capital. So yeah, that is something that you can do. So, and this is how progressive exposure helps you. It first limits your risk. Second, it maximizes the gains because you add to a winning trade when it performs well. Then it prevents overexposure. You're not committing too much capital right away. That is again one major thing that progressive exposure helps us in. Then comes adapts to market conditions. So because all you are dependent on is feedback, right? All you want is feedback, and that too positive feedback. So if you're building positions when you have a positive feedback, you will never overexpose yourself. So that limits your risk. So even in a bad market like currently we are in, you start off small. Like I'll show you how I was invested around 50% with less than 1% open risk, and how I use this framework to get out of the market right now, because that was my trade metrics. That is a separate part. But yeah, I only risk 1% of my capital. And for those of you who are doing this, actively, you would know that risking 1% of your capital is not a very big amount, even in a small, a bad market. And I'll show you how. Okay. So progressive exposure not only helps us limit risk, it helps us maximize our gains. It prevents overexposure, and it helps us navigate through market conditions. It not only all this, see, it helps us instill discipline. So if you have a system in place, you won't have emotions overriding them. So if you know when to scale up, when to scale down, this removes a lot of subjectivity out of the system. And those of you who attended the previous session, I have shared this a lot of times that you need to be objective in trading. See, if you have to do this for the next, let's say 25 years, you cannot have, you cannot be emotional in decision making. You need to be systematic. And see, many people feel that, just an example, a random one, they feel that they are trading flags or they are trading big base breakouts, so they have a setup. Again, that is a myth. A pattern can never be a setup alone. Then they feel that they have a setup, that they are trading, they know everything. Then they feel that they have a systematic approach. No, a setup and a systematic approach are again very different things. So you need to have systems in place which help you limit risk, maximize gains, and help you navigate through market conditions. And this is what progressive exposure does. It helps you navigate through a very bad market. It helps you, push through the limits only when you are performing well. Okay, you have to earn the right to scale up. This is something that, I have taken a printout of and I've stuck this on the wall right in front of me. And I read it every day. See, you are investing your hard-earned money into the markets, and there's no guarantee that you will make a return. कोई भी गारंटी नहीं है कि पैसा बनेगा. मार्केट में ऐसा है ही नहीं कुछ भी. एंड अगर ऐसा नहीं है, तो एक गारंटी तो है कि आप पैसा लूज तो जरूर करोगे. दैट इज गारंटीड. नो मैटर हाउ स्ट्रॉन्ग योर रिस्क मैनेजमेंट इज, यू विल स्टिल बी इन अ ड्रॉडाउन. सो व्हाई नॉट अर्न द राइट टू स्केल अप? अगर मैं 25% प्रॉफिटेबल नहीं हूँ 25% एक्सपोजर पे, तो मैं 50% क्यों डालूं? Why should I move up to 75%? Why should I move up to 100%? So you have to earn the right. And I'll show you how you can do it without getting too late, because there's this misconception that progressive exposure, first, does not work. Second, it is a very slow mechanism. Like, you start off with 0.25%. By the time you move up to 1%, the market turns. See, this is a very stupid way of putting it. People have no idea how to use it, first. And second, see, progressive exposure was a template that Mark Minervini said, like I said earlier. It was not supposed to be used as it is. So the framework that I'll share, you'll see that it has the same concept, but the application, the execution is quite different. So before we actually get to the maths, because it'll be a math heavy session, I would request everyone to have a calculator with you and a notebook and a pen, so that it helps you calculate stuff easily. So before we get to that, some basic terms. What is exposure? Exposure is the total invested capital. So if I have a portfolio of 10 lakhs and I invest, let's say 1 lakh rupees. So 1 lakh is my exposure, right? 1 lakh is my exposure. Average loss percentage. So what if you maintain a journal? I highly recommend that you have a journal with you. If you have a journal, you can take an average of all your stop losses. So that gives you an average loss. So it is the loss you take per trade over a set of trades. So let's say आपके 20 trades हैं, उनके अंदर जो भी आपका stop loss था, if you take an average of it, ये आप Excel पे कर सकते हैं, very easy to do. So you get your average stop loss, and you must know this figure. It is very important. Then comes position sizing. What is position sizing? Position sizing is the invested capital, per trade. So एक्सपोजर होता है टोटल कैपिटल इन्वेस्टेड, बट उस एक्सपोजर को आपने कितने स्टॉक्स में डिवाइड किया है. लेट्स से मैंने 5 लाख का एक्सपोजर लिया और उन 5 लाख में मैंने 1 लाख की 5 पोजीशन बनाई. सो पोजीशन साइज इज 1 lakh and exposure is 5 lakhs. Then comes risk per trade. So this is the amount of capital that you are risking on one particular trade. So let's say I have a 10 lakh portfolio and I'm risking 10,000 on that trade. So that is 1% of my capital at risk on that trade. Then comes win rate. What is win rate? Win rate is the percentage of winning trades out of the total trades that you take. So अगर मैंने 10 trade लिए and in 10 trades, 3 trades I had, I made some profits, and rest of the 7 trades I took a small hit, a small loss. So my win rate is 3 divided by the total number of trades, that is 10, into, you can multiply it by 100, and that gives you your win rate of 30%. I hope all these terms are clear, because iske aage whatever we discuss, I'll just straight away say this is my exposure, this is my risk per trade. So just take a minute and go through this. And once you're done, just drop a yes in the chat box. Then I'll know. Then I'll move on. And for those of you who joined just now, um, till now we've just discussed what is progressive exposure, how most people are getting it wrong. Like they start off with, let's say, 0.25% risk, then they scale to 0.5%, then they scale to 1%. And as most feel that as they get to 1% risk, the market turns and they lose all the profits that they have made. This is a misconception that we'll break in this session. Also, I've shared that whatever you have knowledge of progressive exposure, it is just a framework that Mark Minervini shared, and because of our wrong interpretation, हमने जो उसको गलत interpret किया, like I'll quickly scroll back, and I'll show you the. So here I showed that you start off with $250 risk, then make $500, risk that 500 to make 1,000, then risk 1,000 to make 2,000, and overall you have a $3,500 profit. So in the next 2-3 trades, you risk 1,000 and you lose everything. So this is something that is a very wrong what do you say, interpretation of progressive exposure. So till now we have just discussed this, and I've just shared the basic terms. I hope this is clear. Shall I move on? Okay, yes. Okay, we'll move on. So, just to take things a little ahead, like I said, the risk per trade, your risk on capital, when you divide it by your average loss or your stop loss, that gives you your position size. Position size kya hai? It is the amount of money you invest in one particular stock. So, if you take 3 stocks and add all these position sizes, that gives you your exposure. That is the amount of capital you have invested total till now. So if you have your 10 lakh portfolio, if you and you have invested 2.5 lakh, 2.5 lakh, 2.5 lakh each, so that gives you 7.5 lakhs of exposure. Now coming to the common mistakes that traders do with progressive exposure. See, when you don't understand something, only then you badmouth it, only then you say that it does not work. But maybe the case may be that it does not work for you. But if you understand the core concept that you just have to start small, you cannot make a mistake with progressive exposure. And I'll show you how. Traders are too focused on individual trades. Like you saw in the book, you risk $250 and make $500. So he's talking about one individual stock. So most traders feel that progressive exposure होता है एक एक stock में करके. So they are too focused on one stock. अभी आज मैंने एक stock लिया, let's say 0.25% risk के साथ, एंड नेक्स्ट 3 डेज में मुझे अच्छा मिला, देन आई ऐड 0.5%, बाद में और 3 दिन बाद मुझे अच्छा मिला, मैंने 1% ऐड किया. एंड ये सब करने में वो एक एक इंडिविजुअल स्टॉक पे बहुत फोकस्ड है. सो दैट इज समथिंग दैट यू डोंट हैव टू डू. सो दिस इज समथिंग दैट यू डोंट हैव टू डू. देन दे आर टू स्लो इन स्केलिंग अप. सो फीडबैक अगर उनको मिलता भी है तो भी वो डर जाते हैं कि यार अभी बढ़ाना है रिस्क कि नहीं बढ़ाना, कैसे बढ़ाएं रिस्क, और क्या ये राइट टाइम है. सो ये सब में टाइम निकल जाता है एंड दे आर टू स्लो. यू डोंट हैव टू बी स्लो इन स्केलिंग अप. देन उनका कोई फीडबैक मैकेनिज्म ही नहीं है. सी, दिस इज अ वेरी लेमैन्स वे ऑफ सेइंग इट. आज मैंने 0.25% रिस्क लिया एंड इफ आई गेट पॉजिटिव फीडबैक आई विल स्केल अप. बट व्हाट इज द पॉजिटिव फीडबैक? Just saying that it had a follow through, it had a it moved up 10-15 odd percent, it is not a it is not a positive feedback. It cannot be looked at from a very individual perspective. To bhi aap karenge, it needs to be in a clustered form. So most people don't have a feedback mechanism. So this is, again, you need to have a feedback mechanism. Then comes market conditions. So, Abhi, like if you follow the indices are well above 50-day, and 20-day. Some indices are above their 200-day. So now people feel that the environment is positive and we'll invest money. So, see, market environment is not just moving averages. You need to have a clear understanding of how price works. So, अगर आपने invest करना था, so the right time was around 17th or 18th of March. बट उसके सिग्नल्स 12 मार्च को ही मिलना शुरू हो गए थे. सो आई हैड अ फीडबैक मैकेनिज्म यूजिंग विच आई डिड नॉट इग्नोर द मार्केट्स. मार्केट अभी मूव करना स्टार्ट नहीं हुए थे तभी मैंने पोजीशंस बना ली. एंड अब जैसे मार्केट थोड़ा टर्न कर रहे हैं एंड मेरे को उतना अच्छा फीडबैक नहीं मिल रहा, आई मूव्ड आउट. सो आई वॉज नॉट फोकस्ड ऑन वन इंडिविजुअल ट्रेड. I was not slow in scaling up. I had a feedback mechanism and I did not ignore the market conditions. So you can take a note of this, write exactly opposite of this. I will focus on multiple trades together. I will be fast in scaling up. I will have a feedback mechanism and I will not ignore the market conditions. This is the framework to rightly practice progressive exposure. At last comes emotional decision making. See, everyone of us are, we are humans, we are not robots. We have emotions. So when you don't have a feedback mechanism, when you are too focused on individual traits, you will be emotional in decision making. Let's say आपने अभी तक expose किया ही नहीं है अपने आप को and you're seeing Masdaq. It is one of the most overhyped stocks on Twitter right now. It is not even a good setup. But because it is the only good, an average setup in the market, we are calling it the, the GOAT right now. It is the best setup present, and yeah, many people might be stuck with it. So they are too focused on one individual stock. Just ask yourself, अगर मेरी win rate 30-40% है, तो मैं 10 ट्रेड लूंगा तो कोई 4 ट्रेड ठीक होंगे. अगर मैं एक ही ट्रेड पे फोकस्ड हूँ तो वहां तो मैं 100% है कि मैं लूज कर सकता हूँ. डू यू अग्री विद दिस?
Yes, yes.
So we cannot be emotional in our decision making. So you can, I'll just give you another example again from the book. This is the misconception that people have of progressive exposure. You start off with $250, make $500, profit 500. Risk that 500, make $1,000, add this, and you'll have $1,500 of profit. Only risk 1,000 in the next trade. You lose that 1,000. Now you are back at 500. Next trade you take off 500 and you lose everything. This is how progressive exposure is taught to everyone, correct? And because of this, progressive exposure has a very bad image in the market. But no one talks about that you don't have to focus on individual trades. No one is talking about the scaling up method. No one has a clear cut feedback mechanism. We all ignore market conditions because we are too emotional. Everyone, our favorite trader is talking about Nasdaq. We'll buy Nasdaq no matter what. क्या ही हो जाएगा? We lose a small amount, but that small amount compounds and slowly, you lose a big chunk of your capital. So these are some common mistakes, that often new traders make, even experienced traders who have no idea on how to use this progressive exposure framework, even they lose money because of this. So this is something that we have to get out of our minds. Again, you might, get bored when I continuously talk about this, but I love this guy. He is the reason I have become a profitable reader. All the foundations that he has, imparted us with. So all credits to Mark Minervini for this. If I ask you, what is your goal from trading? Most of you would say, I want to build wealth, I want to be financially free, I want to make a lot of money, I want to make passive money. These are all the common answers that I get whenever I ask someone, why are you trading? But they don't have a tangible or they don't have a quantifiable answer for this. See, if you're too focused on the next 2-3 trades that I have to get it right, I have to make money, अगर ये 5 ट्रेड नहीं वर्क किए तो मैं ट्रेडिंग छोड़ दूंगा, मुझसे नहीं हो रहा है. So see, you will never succeed in trading. You have to, even though you are a short-term trader, but you have to have a long-term outlook. By long-term, I don't mean 25 years. That is just a goal. But in trading, you must plan for quarters. So whenever you buy a stock, it has quarterly results. The management is answerable to in shareholders every quarter. Similarly, you are answerable to your portfolio and to yourself whenever you take a trade. So don't think of trading as the next 10 trades. Think of it as the next 100, 200, 500, 1,000 trades. Let's say a year. So that is what Mark Minoani says. He says that I think of each trading year as the opener of a 12 inning game. So see, even though he's a swing trader, he's not a long-term investor. Even then, his outlook is for a relatively longer period, not 10 days, 20 days, for a year. So this is something that you have to work on and not be focused on one individual trade. You will have 100, 200, 300 trades across the year. So you don't have to focus on that one big trade. Focus on all the trades and treat all of them as equals. And to give you an example, if you plan to run a marathon of I think it's a 40, 42 kilometers, a full marathon. So do you run 40 kilometers on the first day itself if you're starting to prepare? Do you start off with 40
No,
kilometers
no,
on day one?
it will wear us out right away.
Correct, correct, correct.
No.
So, like an athlete, think of yourself as an athlete right now. Would you run 40 kilometers on day one? Would you lift the heaviest weight on day one? No. So, why are we putting the pressure on our portfolio, on our hard-earned capital? And you know what people tell me? They say that हमारा तो portfolio ही sir बहुत छोटा है. Why do this? We can directly risk a big amount. See, this is a recipe for disaster. If you have 5 lakhs right now and you have a job or a business, would you be trading with 5 lakhs your entire life? No, you will slowly and steadily add, more capital, pump in more money as you get better at this. So when you are trading with 50 lakhs, you can't deploy 50% of your capital in one trade. That will wipe out your psychology, not only money. So you need to treat all the capital amount, any capital amount as the same. Think of it in percentage way. So start off small. Learn to pace yourself is the keyword here. You don't have to be 100% invested all the time. Myth. Even with 25% exposure throughout the year, you can still make a lot of money. Even with, starting small, you can make a lot of money. But even if, you miss on a few trades with a bigger allocation, see, that is possible, but it will save you in bad periods. It will save a lot of your capital and a lot of your confidence. So again, this is a page that I have taken a printout of, and this stays with me at all times. And whenever I am feeling low, that I have not made money, and I'll be very honest with you, I have not made money since the beginning of this year, and I'm a full-time trader who's trading for a living. I have clients. I'm not in a very big drawdown, but I don't have, I'm not net positive for this calendar year right now. But I know that trading is not just these 3 months. I am here for a very long time, and to stay on the pitch, I need to safeguard myself, not just my mental capital, but my financial capital. So I would, highly recommend that you take a printout of this and stick this on a wall so that you see it every day. This acts as a daily dose of motivation. So before we get to what I do, we'll run through what commonly people think about progressive exposure. So for most people, progressive exposure is a framework, a risk management framework. Can anyone tell me why is progressive exposure a risk management framework? Anyone? Yes.
Trading with the market feedback,
Sorry.
trading and risking with the market feedback.
Correct. That anyone else would like to add on something?
I think progressive exposure, what I know, not from this class, was what was my preconception like. You gradually expose yourself according to the market feedback and the cushion that you have gained, and gradually you increase the risk that what you have said from 0.5. Okay, now on 0.5 position I have made good money, so now let's risk 1% on trade, and then gradually like that.
Correct. See, the concept is right, and most of us have the concept in our mind, but the execution part is where most people struggle. So yes, progressive exposure is a risk management framework, and I'll tell you how I've divided this risk management in two parts. But for now, the misconception, like I've said hundreds of times in the same session, I think, and you might all be bored with this, but I have to break that chain of thought that this is not progressive exposure, because we are not focused on one individual trade. We are focused on cluster of trades. And if you are following this process wherein you are constantly changing risk per trade, it is again a recipe for disaster. If you're risking 0.25 on one trade and in the second trade you risk 0.4%, 0.6%, then this is not risk management. This is you don't have a systematic approach of scaling up, and this is a guaranteed way of not making money. In a good market you might make, but when the market is tricky to trade, like let's say 2020. Shall we continue?
Yeah, we can continue.
Yeah, okay. So till now we've discussed what is progressive exposure, why we use it, the common mistakes investors do when using progressive exposure, and the common approach, which is, which has a very big misconception, wherein you take one trade, then the next trade, and the next trade. So we have discussed this up till now. So talking about my approach. So for me, progressive exposure is money management and trade management. What is money management? What is trade management? We'll get to that in, the next few slides. But for me, I divide the risk management into two parts. So risk management is a very broad topic, but in risk management, progressive exposure has two parts. That is one, money management and trade management. I don't focus on one individual trades. So if you follow me on Twitter and if you've seen my timeline, when I started, buying some stocks on 18th, I bought Blue Star and I bought Kiri, I think, and on 19th, I bought Ami Organics. Yeah, I think that is the date. So I did not focus on one individual trade. Whenever I'm exposing myself in the markets, I take multiple trades, that is at least 3 trades, trade in clusters. So मेरा ध्यान एक ट्रेड पे नहीं है, मैं एक साथ 3 ट्रेड ले रहा हूँ. And I'll tell you how this helps you. I focus on open risk and not on risk per trade. See, this might sound very different because risk per trade, देखो सारे बोलते हैं constant होना चाहिए. Even I agree with that, क्योंकि that keeps your R multiple same. So अगर मैं एक ट्रेड पे 0.5 रिस्क ले रहा हूँ तो मैं बाकी सारे पे भी 0.5 ही लूंगा, क्योंकि फिर क्या, मैं प्रोबेबिलिटीज अपने फेवर में कर रहा हूँ. Because just imagine I risk 0.3% on one trade and 1% on the next, and 0.3 वाला चला गया 50%, एंड 1% वाला मेरा चला ही नहीं. तो मैं 1% तो रिस्क अपना एक बड़ा कर ही रहा हूँ, एंड 0.3% रिस्क करके मुझे कुछ मिलेगा नहीं. तो मुझे कॉन्स्टेंटली रिस्क सेम रखना है. अगर मैं 0.3% रिस्क एक ट्रेड में ले रहा हूँ, सो दैट शुड रिमेन द सेम अक्रॉस द नेक्स्ट 2 ट्रेड्स ऑल्सो. So whenever I take trades, I don't focus on one stock. I buy 3 stocks at one time, and the risk per trade remains the same. So I focus on open risk. And I have this firm belief that when you're starting from cash, जैसे आप 100% cash में हो right now, and you're starting out, focus on building cushion and your confidence, because these are the only two things which will guarantee if you'll outperform or not. And trust me, I have burnt my hands. I have dealt with this situation a lot of time, and I have concluded over the years that if you have a profit cushion, you will definitely outperform the markets, because you have stability that you're not losing your principal amount that you came with, and you'll have the confidence to execute trades fearlessly. So no, don't focus on one trade, focus on 3 trades at least. Open risk is much more important. Your risk on individual trades should always be constant. And like I said, focus on building cushion, focus on building your confidence. Is this clear?
So Kavish, I just want to ask one thing.
Yes.
When you say that you focus on trading clusters of 3-4 trades, so once I have taken this 3 trades, and one of the trade actually moves in the anticipated direction, and there comes a stage wherein I would think that the markets are choppy and I need to book my profits. So the implication on the other 2 trades, which might not have moved in the same direction as what I had anticipated, then this risk per trade would actually have an implication on the other 2 trades, wherein I booked the profits maybe on the one trade which have moved in my direction.
We'll get to that. I have that, I'll share that. And see, this is a rule, and I'm not telling you this is a template or you can change this. Never risk different on individual trades. Always risk the same amount, because that is how maths functions. Because just imagine, you risk is directly proportional to the capital that you invest. So if you're risking, let's say, 1% of your capital, assuming, and you build a 20% position, and in some other trade you only take 0.5% risk and build 10% position. What if the 10% position moves and 20% does not? So in a good trade you sized up small. So we as traders never know which stock will move and how much will it move. So we need to stack probabilities and odds in our favor. So risk per trade will always remain constant. And to answer your question, that if a trade moves and you book some gains, what the implications would be, we'll get to that. Okay, don't worry. I'll share the exact method as to how you can build a cushion without exiting, or without uh, letting go of a winner. Okay, just a little patience and we'll get to that. Okay,
Yeah, sure. Thank you.
cool. Yes, Rajkumar.
Sir, these 3 to 4 trades we took at one go, right, sir? So my question is like, if I take 1 or 2 trades, suppose if we are in a choppy market, so if I take 3 or to test the waters, I take 3 or 4 trades. If that 3 or 4 are also, I may hit that confidence thing.
No, see, this is I've not yet shared the how you manage the drawdown, and there's a reason. For now, just have
Okay.
this template in mind, wherein you
Okay.
take one trade, you only have 30% probability of winning in that. You take 3 trades, you have 30% probability of winning in that.
Mhm.
So where is a higher chance wherein you'll have at least one winning trade? You got the question?
So yeah.
Yeah. So just keep this framework for now, and I'll not leave you confused with the session. I'm giving everything for you to practice progressive exposure. So like I said, just a little patience. We'll get to that part, and if not, I'm always here, and we'll answer your queries at the end of the session. Okay.
Sure, sir. Yeah. Thank you.
Yeah. So I'll just repeat it, and I want you all to be so bored that you tell me that, Kavish, stop repeating one thing over and over again. But so never focus on one trade. Trade in clusters of 3, not 4. Just remove this from your mind. Only 3 trades. And like Rajkumar said, that you take those 3 trades in a short period of time. So you don't take one trade today, the second trade in 3 days, and the third trade, let's say 6-7 days from now. No, the maximum limit is 2 to 3 days. So within 2 to 3 days, you must have at least 3 positions. So this ensures that if you don't see a setup, you might never expose yourself in the market. So this is again one of the beauty of this system, wherein you only trade if you see a setup, that too in a cluster of at least 3. And if you see the setup in 2 to 3 days, only then you execute. Otherwise, you take a small hit and you're out. And your open risk is much more important than the risk per trade, because risk per trade will always remain constant. And in the end, by the end of the session, I'll also show you what should your risk per trade be. And many people say that you should risk 1% of your capital. It should be the maximum that you risk. See, if you risk 1%, I can guarantee you that all of you would have a 10% drawdown in the next 50 trades. I'll show you how. So your risk per trade does not matter. It should just be constant, a mathematical figure. We have to focus on the open risk. It is the most important thing in risk management. Okay. Assuming that all this is clear, we'll move on to what is money management. Can anyone tell me what their understanding of money management is? apart from, Ravi and Suresh, because they have been answering a lot of queries. Anyone else? Whatever you have, whatever your understanding of this is. If not, then if Ravi, you have something, or Suresh, you can.
So, Kavish, I will go in this. As per what my definition of money management is, I have to manage my money in a way that it, it has less of a drawdown because if there is a drawdown and the capital goes down, it impacts my psychology. And as per your definition of progressive exposure, I would like my money to grow slowly, steadily, and keeping in mind the market conditions. If it's a healthy market, then yes, I would like to take that extra amount of risk. But if the markets are choppy or beaten down and they are just coming up like what we have the scenario now, then I would like to be a bit cautious in my approach and taking care overall of my money, so that I don't expose myself taking more risk and then impacting my capital.
Right,
So,
rightly said. Rightly said. A great explanation, and this is exactly what I wanted to explain, which made my work a little easier. The first step to money management is knowing the allocation per trade. If you have a 10 lakh portfolio, how much will you put in, one individual stock? This is the most important question, because the amount of money that you put in a stock will define your returns. So that is one. And your aim should be to minimum have a position of 20 to 25% in one individual stock if you have a win rate of over 35%. Okay, if you have a win rate of, let's say anywhere below 25% or 35%, then you can never risk, adding 25% in a particular stock right from the start. Okay, this is basic maths, probabilities, and you can we can discuss this at the end of the session, or as to how you decide allocation per trade depending upon your win rate. But yeah, that is one thing you need to look for. And to give you an idea, I never, even if it's a good market, I never put directly 25% of the capital in one stock. Never. See, I even in a good market, I can the trade can hit my stop loss. There's no guarantee that the trade will do good. So I am always scaling into the position throughout the day. I build the position on the breakout day. Let's say I build some in the morning, then midday, and then some end of day. But at the end of the day, I need to be positioned at least 13 to 16%, and in a good market, let's say 20 to 25%. So that is how I allocate per trade. Then comes risk per trade. Like I said, like I told you, that we'll discuss what risk per trade is and how you define it basis your win rate. So both these things, your allocation and your risk per trade, they are heavily dependent on your win rate. So if your win rate, and I am assuming that most of us have a win rate of less than 40%. Mera win rate is 30%, and sometimes it even drops below that. And I have no shame in admitting it, because I have built a system that allows me to make mistakes. So I want to make mistakes and I will make mistakes, but I don't want to burn my hands. I don't want to put a big dent on my portfolio. So my allocation and my risk per trade depends on win rate. That these are the core elements of money management. Now that you know how much you allocate, how much you risk, you need to have clustered exposure. Now, if you remember, exposure is the total capital invested. So let's say you bought four stocks, and in every stock, let's say you bought 10%, 10% in stock A, 10% B, 10% C, 10% D. So that is clustered exposure. And what is individual exposure? You buy one stock with 10% position size and wait for its feedback. This has not worked for me. I don't like the probabilities of this working, and this is what we'll focus on if you happen to follow the method that I tell you. So clustered exposure always, risk per trade remains same, but you'll always buy in clusters. Moving on, example, you decide to take 25% exposure. So you have a portfolio of 10 lakhs, you take 2.5 lakh exposure. So how many stocks will you buy? This is money management. So you're taking, when you're starting from cash, you take 25% of your exposure. This is the invested amount in the markets. अब इसमें आप कितने stocks buy करोगे? It is up to you. You don't have to necessarily buy one stock and risk everything in one stock. Stack the probabilities in your favor. That is what, I am sharing here. Is this clear? Money management?
Yes.
Yes. Okay. If you have any doubts, just write it down. We'll take that at the end of the session. Now coming to trade management. See, how many of you have heard people talking about money management? No one talks about this. Everyone is too focused on trade management. Winner को बेचना कैसे है sir? Winner में enter कैसे करना है sir? Winner को ढूंढना कैसे है sir? See, that is important. But post a certain extent, how you manage your money and how you manage your portfolio effectively. I'm not talking about the stocks. That is what will make you a lot of money. So in trade management, I've shared this a lot of times. There are only two things in trade management. First, how you handle a loser. Second, how you handle a winner. अब loser handle करना ना बहुत easy है. Just take a stop loss and get out. Simple. But when you take a stop loss, ensure that you never take a full loss. Let's say 10 lakh की आपका portfolio है and you risk 5,000 on a trade. So you never hit a stop loss wherein you lose all the 5,000. Ensure that you lose always less than 1 hour. So if you're risking 5,000, try and get out at 4,500. So how you do that, that is another different thing. You don't exit everything before it hits your stop. There are several ways you can manage, to do this. We'll not get into that right now, but just ensure that you risk, whenever you hit your stop loss, you risk less than 1 hour. Never take a full loss, because I'll tell you the reason behind this. Whenever you're taking a trade, you don't know how much slippage you'll get first, and second, you're not incorporating the charges. So a 5,000 loss is never a 5,000 loss. It is always 30% more on a higher side. So if you're risking 5,000, you might end up giving 5,500, 6,000 on that stock. So try and avoid that. Always risk less than 1 hour. Second comes selling a winner. See, selling a winner, most people, confuse this and complicate this. I've shared this, in the previous session also. Just divide your capital into 3 parts. The allocated amount, wherein the first 1/3, you have full control. Second 1/3, sell in strength. Maybe ATR, maybe 25-30% from cost. Okay. And the remaining 1/3, 10 or 20 EMM or SMA, whatever. I'll just write MA. You can decide what you want to use. This is the framework that I use. A simple framework which ensures I get the best of all worlds. Start कर रहा हूँ, 1/3 बेचूंगा, ये पूरा full control मेरे में है. I can sell it at any point. So for this session, we are not focusing on the rest too. इसके अंदर भी अलग अलग rules होते हैं. But for now, we're just focusing on this part. So आपको ना, जब आप स्टार्ट आउट करें, आपको आपका प्राइमरी फोकस है क्वेश्चन बिल्ड करने का. सो अभी के लिए हम सिर्फ इस 1/3 की बात करेंगे, या फिर इस फॉर दिस सेशन वी आर जस्ट फोकस ऑन दिस 25% ऑफ allocation. Okay. So this is how you manage a winning trade. We'll not focus on the rest too. I'll show you how you can use that the 25% that you sell. So let's take an example. You take a 10% position in a stock. So you have a portfolio of 10 lakhs. You buy a 1 lakh position with a risk of 0.3%. अब ये रिस्क कितना है? कैपिटल का रिस्क है, 3,000 रुपए का रिस्क. आपका स्टॉप लॉस कितना हुआ? 3% का. अब I'll show. You can open up calculator on your phone or your desktop. I'll just open calculator and show you how you can do this. Can you see the calculator?
Yes.
So your risk per trade is, let's say, 0.3% of your capital. 0.3% है आपका रिस्क, उसको आप डिवाइड करोगे अपने स्टॉप लॉस के साथ, दैट इज 3। ओके, अब ये जो परसेंटेज आपको दिख रहा है ना यहाँ पे, उस पर क्लिक कर दो एंड एंटर। सो दिस गिव्स यू योर पोजिशन साइज। 10% पोजिशन आपने डाली इस स्टॉक में। ओके, ये क्लियर है?
Yes, sir.
यस, वेरी सिंपल, बट क्या होता है कई बार बात करते करते इट इट बिकम्स अ लिटिल कॉम्प्लिकेटेड। सो 3% स्टॉप लॉस, रिस्क पर ट्रेड इज 0.3%, आणि आपने 1 लाख की पोजिशन बनाई विच इज 10% ऑफ द पोर्टफोलियो. नाउ I just told you that initial 1/3 or 25% is in your control. You remember? 1/3 or 25%. So ये आपके कंट्रोल में है. So whenever you are starting out, this is a framework that I have used, and this ensures that you have some some cushion. So 25% कितना होता है 1 लाख का? I'm talking about the position, not the capital. So 25% 10% पोजिशन का होता है 2.5%. 2.5% जैसे 8% हिट होता है बेच दोगे एंड मूव द स्टॉक टू कॉस्ट. नाउ मोस्ट ऑफ यू वुड फील दैट यार इतनी जल्दी क्यों बेच रहे हैं. See, when you're starting out, like I said, your aim is not to build, make a lot of profit. Your aim is to build a profit cushion. And I'll show you how using this you can invest 100% of your capital without even adding risk. Okay. For now, the rule is, or the template that I'm sharing is, you take a position size के बारे में मैं नहीं बात कर रहा अभी, जितना भी आपने size लिया उसका 25% you sell it at 8 to 10% and move the stop loss to cost, because in any case you are moving your stop loss to cost around 8 to 10% only. So why not sell a very small part to make a profit cushion. Now your trade is risk free, there's no risk on the trade, but you do have a profit cushion. Okay, I just want you all to understand the maths. This is just an example. I'll show you how you expose yourself, and I hope this is clear.
Yeah, clear.
Okay, cool. So moving to the exciting part, the framework. I call this the 1, 2, 3 scale. You remember when we were kids, we used to play games wherein someone would say 1, 2, 3, and we would run, and something like that. So it is based upon that same logic, wherein we start off with 1, then 2, then 3, and we scale. As in when we are moving up, we scale up. That is the framework. It also applies on this way down. You scale down from 3 to 1. So easy way of remembering things. What is 1, 2, 3 scale? First, like I have said, I think hundreds of times in the last 1 hour, always think in terms of open risk. Risk per trade remains constant. All we are focused on is open risk. But you'll ask, how much open risk? Always start with 1% open risk once you are confident about this system. If not, you can always start off small. The maths remain the same. But for me, I have kept 1% as my starting point. Take at least 3 positions. Like I said, risk आपका करना है cluster तरीके में, exposure लेना है clustered way में. So 3 position, it comes to around 0.33% risk on each trade. Okay. The prerequisite or the condition being your average stop loss should be less than 3%. See, if you have an average stop loss of, let's say, 6%, it is too wide for this system. The system will work, but you will take time to get to 100%. But I would recommend you that you slowly work up your way to have smaller stops, and I'll tell you the reason why. But for this example, we'll take an average stop loss of 3%. Okay. So with 1% open risk, you take 3 per positions. Per trade risk is 0.33%. So your average position size, you just divide 0.33 by 3 and press on percentage and enter it on your calculator. You'll know that your position size would come to 11%. But still, I'll do the math and show you on the calculator as well. 0.33 risk, you divide it, press on the divide. Just a minute. Yeah, press on divide. You divide it by 3. Press on percentage and enter. So 11% of capital, 11% position size, you are allocating on one single trade. How amazing is that? Even though you're starting out and your risk per trade is only 0.33%. So in 3 trades, you're already exposed 33%. Now imagine you buy a 0.25% position and only one position with with a 3% stop loss. 0.25 position with a 3% stop loss will give you a 8% size. 8% की पोजीशन बनेगी एक स्टॉक में, वही सेम तरीका जैसे अभी हमने किया. So you wait for one stock to be risk free, wait for positive feedback. So that is a very slow process. You're not scaling up fast. Instead of that, I thought 1% is not a very huge amount. Sorry. You can, if you're not confident, you can start off with 0.5% risk. There's no fixed rule. This is just a template. But you start off with an open risk, divide that into 3, take multiple positions. Don't depend on one position. See, with only 1%, you're exposed 33%. Now imagine if your stop loss is less than 3%, if it is 2%, you would, allocate 17% in one trade. How amazing is that? I'll show you again. We'll get to the maths first. 0.33% risk that remains constant. Imagine one position wherein you have a stop loss of 2%. 16.5% in one trade and you're just starting out. So 16% you have put in, and if you, take 3 trades wherein you're putting in 16%, you're already invested 50%. That too with only 1% open risk. Imagine if overall your, all the stocks on average, even if they move, let's say 5% on average, let's say one does not move, the second moves 10%, the third moves 5%. So let's assume it moves 5% on average. You're already up 2.5% on your portfolio. Do you see the beauty of this concept? Moving on.
Yes.
Yes, Kavish. Yes.
Yes.
You'll not just stay at 1%, you'll now risk 2%. See, you're not adding 2%. The overall risk is now from 1, it moves to 2. So the overall open risk should be less than 2%. Now you'll take 4 positions with 0.5% risk per trade. Your average position size would be 16.7%, and the total exposure is almost 67%. See, you moved on to 2% only when you have had positive feedback. I'll show you what that is. But for now, just assume you had positive feedback. Now you can move up the risk to 0.5% and you're invested almost 67%. And if you remember, I said that I never take a full position right away. So even when I move on to 2% open risk, I am always starting off with 0.33% risk per trade. And by end of day, my risk is gradually scaled up to 0.5%. How I do that, that is something we'll keep for some other session. But yeah, the risk per trade essentially remains the same. Similarly, if you again have positive feedback, you move the open risk to 3%. You're not adding 3%, you're increasing the net exposure risk to 3%. So you can take 5 to 6 positions. Risk per trade remains the same, 0.5%. Average position remains the same, but now you're exposed 100%. See how I got to the level of, how I got to risk per trade of 0.5%. I'll answer that question. But for now, just see if your stop loss, even when the open risk is fixed at 2%, if your stop loss is, let's say 2%, and you risk 0.5% on that trade, how much would you put in one trade? 0.5 divided by 2% gives you 25%. So within 4 positions, you are 100% invested with only 2% open risk. Do you get the point? Does everyone get the point? Any doubts till now?
So this is each time we are closing back and starting fresh four positions, 6 positions like that?
No. We're not closing positions. We are adding on to the positions because
Oh, okay.
see,
Okay.
when we are at 1% open risk, we have 3 positions. So we are also scaling out of these 3 positions because only then we'll free up some capital and add the next 4 positions. Okay. And see, when I told you that you take 3 positions right away, that only applies when you're starting out. Post that, you can be slow because by then you'll have a profit cushion to risk. Okay. So when I say that you take 3 positions right away, that is only applicable when you're starting out from cash. Okay. And see, when you get used to the system, you will find a lot of other nuances and you'll improve on it. Okay. So, does anyone have any other doubts? Keyur?
Yeah, Kavish, so far so good.
Okay. Ravi?
No, carry on.
Akshay? Amit? Jay? Prateek?
I have one question. See, from 1% to 2% you're increasing, then you're increasing the exposure means you're adding the money to all the 4 positions. So.
Sorry?
See, when we are increasing the risk to 2%, or for example, 2%, so and you are adding one more stock. Okay. And
See,
the risk
you can do any of the above. You can either buy a stock or add to the existing 3 positions that you have. Because if you have a winner, why not add to it only? Right? But the aim is, the end goal is to have an open risk of less than 2%. The risk per trade should always be less than 0.5. The number of positions can be, you can have 8 positions in the portfolio. That is okay. But the average position and all these metrics should remain the same. Now it is up to you as to how you do it. This is just a framework. Okay.
So, Kavish bhai,
Yes.
I have one doubt actually. See, like we start with 1% open risk,
Yes.
and if the 3 positions is giving us some positive feedback, then we will go to 2% open risk. Like the same wise, it is if the feedback is going on very good, then totally we will go to 3% open risk. This
Yes.
is the concept, right?
Yes. And see, I'll give you, I was keeping this for the next 2 slides, but chalo, if we are talking about it, I'll just share it here only. We just discussed in the previous slide that if you sell 25% at a profit of 8%, you get around 0.22% of profit, right? Just imagine if all these 3 trades work and at least 8% to move करेंगे, that is something very basic. Because risk free होना है, तो 8% तो होगा, right?
Yes.
So how much is that? 0.66%?
Yes.
So now you have a profit cushion of 0.66%. All this 33% will, come down to, let's say 25% exposure. वो तो पहले भी आप उतना ही ले रहे थे in single position. So in 3 positions, in 3 stocks, you have a total exposure of 25%. Profit है 0.66% का. You move to 2% open risk. So at any point, you won't have 2% open risk because you already have a cushion.
Yes. Yeah,
So
I got it.
your open risk would be
Less than 2%.
Sorry?
It was less than 2%.
Yes, it would be around 1.35%.
Yes.
So 1.35% is only 30% increase from 1% exposure risk. So even though, see, this is the most, the most beautiful aspect of this. You move on to 2%, but your open risk would be around this. Only 1.35%. Similarly, now you have, let's say you take 2 positions of 17% individually, and let's say of 16% to make the calculation a little easier. 25% of 16% is 4%, right? So
Yes, sir.
you multiply 4 into 8. That is, at 8% you sell that 4%. So that gives you 0.32%, right?
Yes, sir.
So 0.32%, you're again building a cushion. So that is how you do it. And see, I would advise you that you don't start to sell at 8% when you have an open risk of 2%. You only do that when you're starting out. And when you're starting out, you only sell when you are at this stage. Okay. Because as in when you reach to 2%, you'll already have ample feedback and a good cushion. So why sell a good position early? Okay. So all these methods wherein you sell some are you follow it when you're starting out. There's no rule that you cannot do it when you have a 17% position or 18% or with 2% open risk. It is up to you. It is that 1/3 or that 25% is in your control. That is what I am trying to tell you here. Is this clear?
Yeah, it's
This
clear.
whole section?
Yes.
Okay. Anyone else? Should I continue?
Okay, carry on.
Okay. So, like I said that, I just shared that your risk per trade should never be over 5%, 0.5% for anyone. This is the reason. When you're deciding your risk per trade, the only thing that it is dependent on is your win rate. If your win rate, see, all of us have a win rate of less than 50%. That is something that we have to accept. I fall into the category of this here. Now, I don't know where you all of or where all of you are. Like you might have a 40% win rate. I'll take an average of the whole scenario. So, on average, there's a chance for us that we might have a losing streak of 9 to 10 trades. This is maths based on your win rate. So if I know that there's a very high chance that I might lose for the next 10 trades, what is the maximum amount of risk I can take? See, I know that I cannot change the risk per trade. So risk per trade remains constant. So if I risk 0.5% per trade and I multiply it by 10, that gives me 5% drawdown. Similarly, if I risk 1% of my capital and multiply it by 10 trades, that gives me 10% drawdown. Or like we discussed earlier, 0.33% or 0.3% risk, you multiply it by 10 trades, you get 3% drawdown. So this is how you decide your risk per trade, because we know it has to, be constant. Okay. Does this make sense?
Yes.
Yes, so this is the framework that you use. Decide a risk per trade and be consistent with it, because I know I cannot stand a drawdown of 10%. My clients cannot stand a drawdown of 10%. So I have fixed 0.5% and 0.3%. Okay. So I always start off with 0.3% no matter how good or bad the market environment is. And I restrict myself to 0.5%. And I only scale to 0.5%. I don't buy a stock with 0.5% risk from the start. I start off with 0.3% and gradually buy it throughout the day. So you can use this framework and define a risk per trade for yourself. I would advise you to not go beyond 0.5% and not below 0.3%. This is a sweet spot to be in. Rest, it is up to you and up to your understanding of the maths. You can, do it for yourself. So to put all this together, what is 1, 2, 3 scale? Start off with 1% open risk from cash. Buy 3 positions with individual risk of 0.33, 0.33, 0.33. Okay. So you start off with this, buy 3 positions of this much risk per trade. Assuming your stop loss is 3%. We are assuming just a minute, your average SL percentage is 3%. Okay. We are assuming that. So each of the position would be 11%, right? And you will have an exposure of 33% in 3 trades. And open आपका जो risk है, it would be 1%. Okay. Continuing. Now, like I said, your average stop loss should always be equal to 3% for this case. Sell 25% position at 8 to 10%, because you're in any case, you're moving your stop to cost. So why not book a very small part of the position? You're already taking a 11% position. People start off with 3, 4%, 5%. So you're already having an edge over them. You sell around 3% position, you're left with 8% size. But if things go as per your plan, you will have a profit cushion of 0.22% on individual trades. So all this risk is nullified. All you have is a profit cushion of 0.22% individually. See what this helps you in. It helps you in increasing your risk to 2% because we're not trading with just this 33%. And in, many people think that we are, just give me a minute, I'll write this down. 33% I had position and I am exiting 25% from it. How much is that? 33% minus 25% gives you around 25% of size of the overall exposure. Is 25% a bad amount? Is it a very small amount when you're starting out?
No.
No. So how are you positioning yourself? From 33%, imagining that all these three positions worked out for you. You sold 25% of 33%, that is around let's say 8.5%, and you now have an exposure of 25% with a profit cushion of 0.66%. See, this might not look like a very big figure right now, but imagine now you can take up a open risk of 2% and you have a profit cushion. So this is your positive feedback. This is part of your positive feedback. See, this is much more nuanced. This is not this. इसके अंदर we have several other things as well, like trade management, the feedback on balance, the setup or pattern. There's a difference between the two. How well a setup is working in that market. How did you scale in partials? So everything falls back into the category of positive feedback. But I hope you get the point. Like, you have to start off small, build a profit cushion, then scale up. And trust me, you would never have to go to 3% open risk. In about 2.5% open risk, you'll be 100% invested. Like right now, I booked the gains from the three positions and I have a profit cushion of 1.7%. Now, whenever I start off again, I am 100% in cash right now. So whenever I start off again, I can directly start from 2% open risk with only risking 0.3% of my capital because I already have 1.7% profit. So with 2% open risk, I can be 100% invested whenever I see some setups and good feedback on balance. So this is how 1, 2, 3 scale works. Any doubts here? No? Okay. So this was about progressive exposure, the misconceptions about in the market about progressive exposure, how I manage money, wherein I am not dependent upon a single stock. I trade in clusters. How open risk is much more efficient than tracking individual trades, and how you can do the same without risking too much. Because when we focus on individual trades, it takes a lot of time, and I think it is a very inefficient way of doing it. Also, a disclaimer that this is not a strategy. This is just a framework. You can tweak it for your liking. Just discuss it with me so that I can help you with that. And this alone does not work. You need to have a setup. You need to have entry criteria. You must know how you will scale into a position, because you cannot start off directly with a 25-30% position. How will you manage it, where this works in a cycle. And yeah, this was about the session. I hope you got some clarity about what progressive exposure is. This was just my perspective of it. You're free to implement it. You can tweak it for your liking. Yeah, and if you have any doubts, this is the time you can ask me, and